and crew with special guest Michael Kilner today, and we are going to be talking about money, money, money. So while we are waiting for people to pop on, let me just give you my usual introduction, which is what is Coffee with Christy? So Coffee with Christy started out as our coaches mastermind, and we have such great coaches. We pick each other's brains and help each other solve problems. And we thought, well, why don't we just open that up to the wider community? And then as we went along, we started inviting guests because there's a lot of times where we need an expert to help us with some of our challenges. So today we have Michael Kilner. Upcoming calendar, I'll give you that, and then we'll jump in. So today, early bird prices expire at midnight tonight for Rock Referrals Like a Boss class, which is December 6th, 7th. I think it's the 7th. Awesome. And then we have tickets going on sale soon, hopefully, for Practically a Boss in January, brand new class. And we have our academy launching March 7th, which is brand new, super secret. We haven't even announced that yet. You guys are the first to know.
Whoa.
And our early notification list is open for next year's retreat. We are also booking classes in person as we speak right now. So if you're looking for a class to come to your region, your market center, your brokerage, reach out to me and we'll see if we can connect and make that happen. So today we're going to be talking about all things money. I'm going to ask you guys to put in the chat right now, why are you on the call today? Do you have a specific question? Do you just want to kind of learn about the topic in general? Is there a very, an area you're struggling with? I pulled some questions from our Facebook group. And before we chime into that, you guys go ahead and type into the chat, and I'm going to introduce you to Michael Kilner. So Michael, why don't you tell us who you are and what you do?
Yeah. So, thank you for the intro. Thank you for having me on, Christy and Brooke. Frankly, I just want to hear more about this academy concept. So maybe just turn it back on you guys. No, sounds really cool. So I live in the DC metro region, on the other side of the river from Christy. I'm in Maryland. She's in Virginia with a little, I voted. Virginia has strange elections.
Right. Election day, everybody make sure y'all vote.
So yeah, I live in Maryland. My wife and I have 4 little kids. And what I'm doing when I'm not being a dad and a husband is I help real estate agents with their finances. So me and my team, we work with about 60 real estate teams, all over the country. And we've consulted with a lot more than that. But we do everything from bookkeeping to payroll to some tax prep. But the majority of what we do is advising. Majority of what we do is just being that sounding board. Today, if I go through my inbox, I probably have 4 or 5 questions already from clients today, asking for a recommendation about a salary that they're about to offer. Someone asked for a recommendation on a 401k plan because they're not happy with the one that they have. So we're sort of that real kind of sounding board advisor, and in many ways sort of fill the gap that people who are mostly just focused on tax prep, CPAs and EAs who are only focused on tax prep, we fill the gap that they can't really, right? Because our subject matter expertise is with real estate agents and their finances.
Here's one thing I love about you. Correct me if I'm wrong. Your background prior to this, you've actually been on a real estate team, correct?
Oh yeah. No, yeah. So I was the director of operations for my brother's real estate team. So we started at Keller Williams. I started in 2013. We were there for 3 years. We started an independent brokerage, ran that for 3 years, sold that brokerage. And that whole time I was in operations and I was in finance. So I look at it really from your seat, as the agents and as the admin professionals, because I really know what you're looking for. I don't really care, what the tax guy says.
Okay, so that's exactly where I just wanted to start. Right. I wanted to start with that question because that was one of the questions that came up in our Facebook group. People get confused between the P&L that the accountant sends them, the P&L as for MREA, millionaire real estate agent model. Talk about the differences like between the two. What do you use them for? Stuff like that.
Yeah. So I think the intention should be that you only have one profit and loss statement, and it can be used for a tax return, and it can be used to inform your business decisions, right? There should not be parallel systems. If there are parallel systems, we're duplicating work and things are going to get lost. But where folks will see differences, right, in what their sort of like what their profit and loss says versus what their Schedule C or their S corp return or their partnership says is in adjustments, right? And so we've got two sort of forms of adjustments. One is very specific to real estate, and one would be for any business. So the thing that is very specific, the adjustment that's very specific to real estate, is that we want to look at everything through the lens of gross commission income, GCI, right? That's how our models are built. Whereas a tax return is only looking at the 1099 you got from your brokerage. And there's always a difference between those two numbers, right? Your gross commission income is going to be the total commission that you were part of during the year, right? And your 1099 income from the broker, which is your gross profit, is going to be net of all of that cost of sale, right? Those splits with other agents, those referral fees you paid, the concessions.
So if you're on a
the agent,
team, you want to be looking at the whole picture of the income of the whole team as a business.
Yeah, or even just
you as an individual who got paid a certain amount of commission.
Yeah, so that's going to be a big adjustment, right? You're not going to start with the GCI number on a tax return. Even though your books are going to have it, you're actually going to start with the 1099 number from the brokerage. So that's the first adjustment that you got to make and kind of understand when you're looking at the tax return. The second thing, this is sort of the second set of adjustments, are all of the things that are sort of discretionary, that actually require, in many cases, require an accountant to think through with you. So it'd be things like retirement plan contributions, right? Those don't actually have to be done during the course of the year. Let's say you have a SEP IRA, or you just contribute to regular IRA. You actually don't have to make any contributions to those until you file the tax return. So for 2023, right, this year, you could decide when you file the tax return in April that, hey, I actually want to put some money into my SEP IRA. So that would be an adjustment, right? It's not going to show up on your P&L for this year in 2023, but it'll adjust on your tax return.
I want to back up a little bit because you did another comparison, which is an important comparison, but I want to back up to comparison with MREA model, and what you just said about retirement is actually a great example. So if I'm the owner of the business, I'm the team owner, and I'm doing something for retirement that I'm not doing for the whole team, I'm just doing it for me because my accountant said it would benefit me. But my director of operations is looking at the profit and loss statement.
Yep.
That's where I was going with the difference between P&L for MREA model and a P&L for tax purposes. So can you talk about that a little bit?
Yeah, for sure. I think that's, owner comp, right? And decisions that an owner might make about how they're paid, how their benefits work, how they're in other ways compensated. Those would be things that we would want to put below the line, right? And we're going to have two net income numbers. We're going to have a net operating income.
So time out. I'm going to take you super simple.
I'm getting too far ahead of myself. Sorry.
Well, no, but you're bringing up really good concepts, because that was another question. Explain the concept. What does below the line and above the line mean? A lot of people are confused by that.
Yes, it actually, and to make it even more confusing, is like it means different things to different people. But when we're talking about it, I think this sort of, to simplify the definition, is think about like what is core and essential to the business, right? No matter how the owner gets compensated or paid, right? No matter what car the owner drives, right? No matter what sort of health insurance plan that they're doing, that's actually not core to the business. That's something ancillary. And so you have to think of anything that would be above the line would be things that would be common across any team, right? So how they pay. So
let's take that example that you just brought up, car. So if the owner puts his car, it shows up on the P&L, my car payment shows up on there, it would be above the line If anyone in that role, any listing agent on the team, for example, got their car paid for by the business, that would be unusual. But if every listing agent, no matter if it was the current owner or you hired somebody, it would be above the line. If it was just because, oh, he's the owner, so we're going to put it on the P&L, then it would go below the line. Is that right? Okay.
Right. Yeah. So there are things that you want to make sure that you said it. There are things you want to make sure end up on the tax return because they're legitimate deductions, right? That the owner of the business should be able to take, but they should not necessarily be commingled with the other legitimate expenses of operating a business, right?
So give us some other examples of areas where you see people getting that mixed up. Some things that are above the line that should really go below the line.
Yeah. So I think owner and officer compensation in S corps is a big one, right? There's sort of this, okay, let's say we have 5 employees for a big team, right? And I'm just going to use that as sort of a big team example with 5 employees. The owners payments, right? What's coming to them, they might have a very sort of liberal view of what is reasonable compensation for an S corp owner, right? So if you're not familiar with it, an S corp owner needs to take reasonable compensation in the form of wages, right? W-2 wages from their business.
That's a tax law
right
requirement.
Yeah. So
right.
But some people think, oh, that means that I should take $36,000 in wages, and some people think, yeah, that I need to take $200,000 in wages. Obviously it very much depends on the total income of the business, but some people take a very aggressive view to reduce their tax burden by really keeping their officer comp low. But let's say that the officer wants to actually take very high W-2 wages, right? They want to take $200,000 out of the business in the form of wages because they have an aggressive retirement plan or because of other reasons. There are reasons why you would want to increase your W-2 wages. Well, if you just stick that into the section of the P&L where all of your admins are getting paid and all of your contract labor is getting paid, right? And your transaction coordinator and the benefits for the team, your payroll processing, right? You're going to be constantly looking at the P&L and trying to solve for that amount. You'll be constantly looking at it and saying, okay, so how much do we need to take out of this calculation to see if we're on model for that particular section, right? Let's say it shows up and you run it against your GCI and the total compensation is showing up as 40% of GCI. You're like, oh my gosh, everything is wrong. Blow up the whole team, get rid of everybody. Well, if 25% of that is the owners compensating themselves and it's just mixed in there, well, that's going to be a problem because that's not how the model is not built with that kind of owner compensation in mind. So that'd be an example where you pull it out.
How do you advise teams if a director of operations, our goal is to be looking at the P&L and comparing it to the MREA model? Are we tracking on track or off track? Are we on purpose on track or off track? Do we need to make any adjustments? In that example, what is your advice? If owner wants to take 200, what's your advice to figure out if I'm on model or not?
Yeah, let them take 200, but have their wages and the taxes associated with their wages show up on a below net operating income in the other expense. Yeah, below the line, right? Because then, like, it's a legitimate business deduction. You can't miss that. You don't just leave it out. Just like, oh, that's,
Okay, so let me ask another question related to that I get all the time. In fact, I think it came up in the Facebook group. So if my team owner, so that's a team owner that's just, I own the team, but I'm not in production. I'm going to take 200,000. My understanding would be, well, what would any owner be paid for that role on the team across, businesses, and put that above the line, put the rest below the line. But what if I'm in production? What if I am also a listing agent on the team? How should it show on the P&L for purposes of comparing to the MREA model?
Yeah, so this one is a little bit tough, actually. And it gets sort of into like how accounting systems work, which is more than I think we have time for. But I think that's sort of the simplest way to think about this is to think of every agent as a profit center, including the lead agent, right? Including the rainmaker. So the way that I set up most of my P&L statements for my clients is that every time a deal comes through, right? Every time a deal gets closed and we see the deposit come into the bank account, we need supporting information, right? Supporting documentation on that deposit. We're not just going to take it like, oh, okay, we're just going to stick that in as income, right? We want to know, is this a listing side? Is it a sales side, right? What was the total GCI? What was the commission paid out on it to the office, right? Were there royalties paid? Were there transaction fees? Transaction coordinator? Like, we want to know all of it, because you miss pieces of it, you're dealing with bad information, and that's what we don't want. And we also fundamentally want to know who was responsible for that production. So we actually think of a P&L, right? It's one column, right? It's one column that you have, and it's just, here's the category and here's the amount paid out, right? And here's the category and here's the income associated with it. Well, we want to actually think of it as multiple columns going across, and those columns have headers with the agent's name on it, right? So we actually use, if you're familiar with QuickBooks Online, we use the class feature for this, because really what we're trying to get at, and sort of to your question, is what is every agent accountable for in terms of GCI? What are they costing the team in terms of their splits, right? If they're an agent on the team, and then what is their gross profit? So the way that you try and figure out, okay, how much would an agent on the team be compensated, right? Even though they are the leader, is you look at, okay, what is their gross profit versus what is the rest of the team? And that's also very helpful, right? It brings up another point.
I'm confused. Am I the only one confused by that? I can't tell. You guys all have your cameras off. I need your faces on here.
Amber said no, she's not confused.
Okay, Amber's not confused.
Oh, she says I am also confused.
Okay. Kirsten, are you confused? Okay.
Let me
ask the question the way I think I understand it, and then if I'm not correct, you tell me how to fix it. Okay, so we have a few confused people. So if I have a rainmaker who is also in production and he closes a listing and the commission split is 50-50 to every agent on the team normally, do I show that transaction income and payment out on the P&L as if he was any other agent on the team?
Well, you got to think that there's a sort of fundamental issue with doing that, right? Okay. Because where is that payment going to go, right? This is his profit and loss statement that he's using to prepare his taxes.
Well, no, we're not talking about his profit and loss statement. We're talking about the profit and loss of the business.
Sure, but if he's the team leader, it's one and the same, right? That's where the nuance comes in.
So the question is, if I'm a director of operations that I want to take my P&L and compare it to the MREA model, how can I do that when my rainmaker's in production? What do I need to do in order to be able to do that?
Okay, so you turn on the class feature in your accounting system, right? Because what that will do, right, is if you think about it is, we want to be able to connect the GCI brought in by an agent, right, with what ended up in the bank account of the team for every single agent, right? So let's say we have agent A, right? They've accounted for $100,000 of GCI. They have cost us $50,000 in cost of sale, and we've ended up with gross profit of $50,000 deposits in our bank account, right? Like, does everyone understand that? We get that sort of, right? So, but we want to be able to see that.
So for that owner, what's going under cost of sale? That's the question I have.
That is the question. And this is why it's tricky. And this is why you keep getting the question, because the only way that you can actually the only way that you could book that, right, is by creating an offset, right? Because think about an accounting program, right? Like if we're trying to reconcile to a deposit, right? So the owner, right, who should have gotten, like if they were an agent, they should have gotten paid 50% of it, but they were paid 100% of it, right? The company was paid 100% of that. What you could do is you could create a virtual cost of sale, right? But you would need to offset that someplace else on the P&L, right? So you could say, okay, for a $10,000 commission check, right? We actually got, let's say there's no cap, there's no royalty, that's all done, right? It's a $10,000 GCI and we received $10,000 in our account, right? There's no cost of sale there. But we want to create virtual cost of sale to see what the owner would have been paid, right? You could have an entry that says, okay, we're going to say $5,000 went to the team leader, right? Because that would be their cost of sale. We say that's their listing split on that, $5,000. But then we need to offset it someplace else. So we had to add it back in. You could add it back in below the line. You can do that. That's a huge pain in the butt. Let me just tell you, like we run that for some of our teams. It can get complicated. So I usually recommend, right? And people are free to create the virtual thing. It works for some people. I do recommend that you simply use the classification feature. So you can look and see how much total gross profit has the team lead brought in versus the rest of the team and the team members, right? I think that's the most important thing for a team lead to kind of keep in mind.
Well, you also want to be able to compare your cost of sale to the MREA model cost of sale. If we're shooting for a 30% cost of sale and I'm not putting anything in that column for all the production my rainmaker has, but now my rainmaker is going to go out of production, I don't have any.
Well, that's the
apples and
thing.
oranges.
That is the thing, is that I rarely see 30% cost of sale hold up in any company where the rainmaker isn't in production. Structurally, it just doesn't work, right? If you think about it, if we just take it, simplify it as much as you possibly can. Think about one deal that happens on a team, right, per year. It's like it's $100,000 gross commission income. The rainmaker is out of production, and their policy is they do a 50-50 split on every deal. If they're out of production and the agent on their team closes that one deal and they pay out $50,000 to the other team, you're at 50% gross profit. So I think, yes, it is important, but you can't actually just stick to the 30% sort of the 70%
Right,
gross
but my
profit margin.
point is, if you had in that example, you've got $100,000 income and I don't put it under cost of sale because it's all coming to me, the owner, then I look super, super profitable. But if I'm going to go out of production and someone else comes into that role, we're really not so profitable as we look, because anyone else would have paid 50% out.
Oh, of course. I totally agree.
Right?
I'm not saying that you hide the ball and fool yourself into thinking you are more profitable than you actually are. But I think we have to also deal with the reality that, like, there is no reality in which you stepping out of any production is going to get you to a gross profit margin of 70%. It just simply, right, structurally, it won't hold up unless your splits with your agents are amazing, right? And you're only ever paying anybody 30% on a deal. Does that make sense?
Let's move on to another question that comes up a lot, which is, we often have team owners who own multiple businesses. So I might own a transaction company and have a title, like, I have people in my organization that work for multiple businesses. How do you advise people on allocating salaries and things like that?
I think that's a great question. And actually, you see a lot of expansion teams also are sort of in a similar sort of scenario, depending on their structure. So what I always say is sort of the simplest is, you have to think of, you really don't want to pay people W-2 wages out of multiple companies. Not that you can't, right? Someone can receive a W-2 from as many companies as they want in a particular year. It's all going to end up on their tax return. That's fine. But think of the administrative sort of headaches of that. So you have to pick sort of a centralized HQ, right? Where does everybody's salary get paid out of? Just for purposes of making sure that, somebody is that somebody whoever's administering it doesn't have to work in multiple, payroll processing platforms. It would be a real headache. But then you have to look at, okay, that hub then becomes almost like a professional employer organization, right? So each other company that might use the resources of that hub, right? The transaction coordination company, the investment company, right? Whatever it is, they will owe a flat fee for the portion of the hours that that person works, right? So they will owe a flat fee back to the other company. And that's where I've seen it works very well that way, right? The employee is not concerned about getting multiple, paychecks. They just get one paycheck, right? But then the companies are being just with each other, right? There are these intercompany transfers that are making it all work out. It's like, okay, if you're spending 30% of your time over here working on this thing, then that other company needs to compensate you for 30%
Are you
of your
seeing
salary.
people do that monthly, annually, one adjustment
Monthly.
per year, monthly? Okay.
No, it should be monthly, right? It should just be very predictable. And so then on the company that's sort of leasing the employees, the company that is leasing the employees, they're still going to book that as under compensation, right? But it's going to be under contract labor, right? Rather than under salaries. And that's just like, if you book something as salaries, that's not actually a salary that's right that you're paying from your EIN, it can make the tax return very confused, right? For your accountant. They'll be like, okay, wait, what? You paid W-2 wages? Because you have salaries here. Like, no.
Yeah,
No.
it's contract labor.
Contract labor.
Okay, and then the second part of that question that came in was, we often have EAs who are working for a rainmaker, and part of what they do is for the business and part of what they do is for the rainmaker personally. Do you just handle that with above and below the line?
Yes. Yeah. So if there's that's a tough one, right? Because that's just sort of this constant adjustment of like, okay, well, how much of their time is actually being spent here versus there. And so that one's a little bit tougher because it's not an intercompany transfer per se, right? So the rainmaker, I mean, it's just depending on how sort of diligent and detailed you want to be on this. The rainmaker could, cut a check back to the company for those personal services. They could, right? But how many people are actually going to do that? I don't know, right? But that would someone could elect to do that.
Okay, I want to move to one of the questions in the chat. Kirsten, do you want to just go ahead and ask your question directly? There you go.
Yeah, I put a few things in there. But when we were just talking about the P&L and how you're accounting for the cost of sale, we work with a CPA that built in QuickBooks our MREA chart of accounts, but doesn't understand. So I go in every month, and so what I've started to do is add in the delta between the gross GCI to the P&L, and then deduct off, like break down all the different cost of sale, like buyer agent split, referral agent fee, those types of things. So it actually shows everything, but it's a very manual process for me. So finding out another way to not do that, having to do that like that every month would be great.
Yeah.
Also, do you work with and my rainmaker is, when we look at the P&L, it never matches our closing tracker, it never matches the bank, and that's it's just a frustrating conversation, to have.
Yeah. No, these are great questions. I think these sort of get to the heart of a lot of the conversations I have with agents all the time. So the first question about sort of the process, what system are you using? What platform are you using?
Into it, QuickBooks.
QuickBooks Online, right? Or QuickBooks Desktop? Which version?
Online.
Okay. So it is a manual process.
Okay.
So the first thing is it's a manual process, but there are some tricks that will make it easier for you. So
Okay.
Have you ever used the recurring transactions feature in QuickBooks?
I have not, but I know it's there. Yeah.
Yes. So what you need to do, go into QuickBooks Online, go to the recurring transactions feature. This is for everybody. If you're somebody who manages it on your own, this is a great sort of like, it will probably save you, I don't know, 20 minutes, 30 minutes a month. and this is why we do it for all of our clients, because it saves us in our workflows. Go to the recurring transactions feature, start a new recurring transaction. It'll be a deposit, right? And it'll be the deposit to the bank account where you normally receive your commission checks, right? At the top, it will say, like, what schedule do you want this to run on? And we want to say no schedule. We want it to be an unscheduled recurring transaction, right? We just want it to basically sit there as a template. We don't want it to like run every month or something. That's not helpful. Just want it to be there as a template. And so what you do is you build out the template. Like, think of all the things, Kristen, that you have to, like, all the line items you have to enter in to get to the baseline deposit every month. Build all those lines in for yourself, right? Build it one time, save it, and then name the template, right? And let's say you have multiple agents on the team. You can have a template for every agent, right? So you're like, oh, okay, this agent closed this buy side transaction, right? So I'll have a template that's saved for, Mickey agent, on buy side transactions. And when I see a deposit that matches up with that, I'm looking at the bank feed, right? I go to my recurring transactions. The line's already there, so I can just fill out the numbers, save it, and then I go back to the bank feed and there will be a match waiting for me. So that's the first thing. So that hopefully that will help your workflow a little bit. Also, Christy can give out my email, right? If you have if you want to send me a screenshot, like, hey, am I doing this right? Like, yes, please send it to me. I will let you know.
Brooke can drop
thumbs up or thumbs down
in the chat, Brooke.
Yeah. So your other question was about the P&L not matching the bank account or the P&L not matching the tracker. Okay. So let's dive into that. What's the question about, like, what is the difference between the P&L and the bank account, and like how do they want to see that?
Well, how do you account for, I guess the questions always comes up because commission, we do our best to get all of our commissions in by the last day of the month, so they count for that month, but never fails. Every once in a while you have one. So like, it's not showing you, like, our closing tracker shows us these were the closings we had for the month. And then the P&L shows, like, this is what was in the account for the month, but they don't match because one of those closings was from the prior month.
Right.
And one of these closings won't hit until next month, one of these commission checks. So,
right.
I mean,
just move the date back.
Way around that.
Just move the date back. Just move back.
In QuickBooks?
Right? So like in QuickBooks, right? It's let's say that this week, right, on Monday, yesterday, you got a commission check that was for October because someone in the back office was just taking their sweet time with it, right? It was on October 31st closing on Halloween, right? So yes, the bank account is going to say, hey, this cleared on the 6th, right? But that was an October closing. Okay, just in the bank feed, right? It's going to say, by default, it will just default to the 6th. But if you go and actually click on that deposit again, after you've done, right, all of your sort of like add backs and everything, manipulate it, just go up and change the date. Move it back to the 31st. Now, the only time you really have to be careful about this is at the end of the year, right? That's where you don't want to be manipulating money year over year. Month over month, it all kind of comes out in the wash. Right. So long as you're reconciling to your bank statements and you're clear on, like, okay, what's actually a cleared transaction and what does the bank say when it cleared versus ours. So you just be really careful about the end of year stuff, right? Because you really want your 1099 is kind of the ultimate source of truth because that's what gets sent to the IRS, right? So your broker 1099. That's the ultimate. That's what they're going to get. So if you have a vastly different gross profit number that you're reporting on the tax return, they can be like, hey, whoa, what happened here, right? And that can be because people are moving things back and forth year over year. So I think that's the easiest way is just to move it back, right? Like,
so just don't schedule any closings the last week of the month. It's the worst customer service time anyway.
I tell you, I know.
But it'll happen, and checks will get delayed and that kind of stuff. So yeah, just move it back.
Okay, another question that came in was around cash flow and reserves, best practices. What should people have in reserve? What should they be looking at in terms of cash flow, things like that?
Yes.
Pretty broad question.
it's a super broad question, but I think there's just principles, right? We just have to go off of sort of principles on this one. So the first thing is to think, you have to look at what is your monthly expenditures from the business, and stop forgetting about what the owner needs to pull out of the business every month to pay themselves and feed themselves. That's the mistake that I see people make. There's like, oh, we're spending $20,000 a month, so we just need, we need $20,000 times however many months of reserve we want. So let's say we want 3 months of reserve. All right, we need 60 grand. We'll be okay. Well, there's another pull on your cash reserves, right? It's on the balance sheet, and we just never really look at it, right? It's the shareholders' distributions, or the owner's draw, or the partner distributions. However you have the structure, right? It's not going to show up on the P&L. It's going to show up on the balance sheet. Also, look at the balance sheet every once in a while and think, okay, what are the other? Are we paying off loans, right? Do we have an SBA loan on our balance sheet, right? The interest will show up on the profit and loss. The principal is not, right? It's just going to pay off that loan balance that's on your balance sheet. So you really have to think, you have to look at what is sort of our total cash flow needs. And then, right, once you actually have that figured out, that's all of your expenses, plus any owner pay, plus anything else that's going to the balance sheet, right? Payroll clearing amounts, like for health insurance or paying off a loan, right? Once you got that total, then you decide, okay, how many months are we like comfortable with having in reserve, right? So let's say that the number ends up being $30,000 once you total up all of your cash needs for a month. Are you comfortable with 3 months of reserve? Are you comfortable with 1 month of reserve? I actually have clients who have told me, like, I don't want any reserves in my business because it sets a fire under my butt to go out and do more deals. I'm like, okay, it wouldn't be for me, but
what is your recommendation of best practice?
I think 3 months. And I also think that you are not going to always need it in the same way throughout the year. This is a very cyclical business, right? So you have to look at, when is your cash really strong and when is your cash flow very weak? So we are coming up on the weakest cash flow portion of the year. So now is the time where you should have max reserves, right? Now is not the time. If you're a rainmaker, if you work for a rainmaker, or you are a rainmaker, and you're thinking, I really need to go out and buy a new truck because I would like to get a tax deduction this year. Well, let's not focus on the tax deduction for a second, right? Let's focus on your cash reserves going into next year. If you have just amazing cash reserves and you can get yourself through January, February, and March, paying all your expenses and paying yourself, right? Okay, fine, go buy the truck, right? But if you can't say, yeah, I can get with my free cash flow or my cash reserves, I can't get through January, February, and March if I didn't close a deal, then stop, put a hold on that. We need all the cash we can get. So that's really where I think there are very critical points in the year where you need to have that reserve. And if you don't have the reserve, you can end up making really poor decisions.
Well, and we saw this during COVID. I can tell you that there are multiple teams out there who lost fabulous staff members because they didn't have reserves when COVID hit, because they were expecting it to be a good time of year, right? March, April, May, typically a great cash time of year, and they didn't have reserves and they had to let people go. And those teams did not grow and take advantage of the market when we rebounded the rest of 2020. So I actually, as a business owner, err much more conservatively on the reserve side and recommend higher reserves. That's just my personal risk tolerance, seeing what people lost. There was a huge opportunity cost to that.
I think that speaks to, it is, some of it is practical, some of it is psychological, right? Absolutely. So like, what puts you in the best place to perform, right? Is it having a really good reserve? So you're like, hey, I got that covered. I don't have to think about it and I can just go and execute. Or for some folks out there, they're like, no, I want to be super lean because that puts an edge on me, right? Like that motivates me. Like, I'm going to go out and close that next deal because I know that if I don't close the next deal, I'm not going to have funds available. It's legitimate. I mean, there are people who operate
so from
that
a
way,
coaching point of view, knowing that most of the people, I recognize a lot of the names on this call, most of us on the call are operations people. So those are conversations, if you're the DOO or the COO of the company, that you should have with your team owner. What is your risk tolerance? What is our goal? And I will tell you that many team owners don't track this number. They don't actually look and aren't aware. So as much as we have an opinion and we have a discussion with Rainmaker, it's team owner decision on it, but it's our job to make sure they have the awareness and the information they have to make good decisions. We give our input on the decision, they make the decision, but many team owners are not looking at these numbers. They're not looking at cash flow. They're not looking at reserves, and we should be doing that with them.
Yes. And I think the other thing to add to the conversation, yeah, if you really want to be a super value add to your Rainmaker in this, is also factor in tax reserves. Factor in what they're paying towards taxes, how they're paying those taxes. Are they doing it through withholdings on their W-2? Are they sending in estimated payments? You know, are they just sort of saving throughout the year and making a big payment at the end of the year? Just make sure it's part of the conversation, right? Because you know, it's 20 to 30% of your net income, right? Is gonna be going to taxes, and it's almost like the last thing that we think about in many cases. No, it like has to be part of every conversation, you know. So maybe you're sitting on a huge cash reserve right now, and taxes haven't been paid for the year, right? Like those are good. It's gonna be gone really quick. So let's just say, all right, let's make these calculations. Let's say 25% of net income is going to go to taxes. Well, where does that leave us, right? If we had to make a tax payment today, where would that leave us? So if you're gonna be having the cash flow conversation, always kind of bring in the Rainmaker team leader's personal tax liability into it, especially if you know it's something that they're constantly trying to stiff arm, right? And they're constantly late, or they don't want to touch it or deal with it. Well, like that's something that if you just bring clarity to the conversation, right, and you surface it for them, they don't have to expend the mental energy trying to figure it out themselves.
Yeah, love it. Okay, any other Kristen had a question about whether you do advising. Let me scroll up to it. Kristen, what was your question about investment properties? I don't see it now.
Yeah, it was about, you know, I'm on a team and our owner is getting into, starting to do like flipping or, you know, and buying investment properties and things like that. And so just, you know, how, as far as the services that you provide, do they cover, you know, other areas? I mean, do they cover that?
Yeah.
The agent, you know, is expanding into other interests.
Yes. So for teams that we work with, you know, if they have some sort of ancillary business like in investment properties, we'll help with those as well. We don't do them as one-offs, right? We just structurally, that's not how we are built. But I think sort of core concepts with this is where we run into a lot of issues, is you have to separate out those books super early, right? If it's a different business line, it should be running out of a different QuickBooks account, right? We just got to do that. I know lots of folks are just like, oh, I've got money here, so I'm just going to spend the money that's here for this next thing, right? That slows down the process for everybody, right? It slows down the process for the bookkeeper. It slows down the process for the accountant, right? It slows down the process on the team side, because they're like trying to constantly solve for like, hey, what are all these expenses here? They're all mixed in with our other stuff. Like, how do we figure this out? And then, you know, people's heads explode and then they get behind on their accounting. So I think sooner rather than later, just separating everything into separate bank accounts, right? Even setting up a different company entirely, setting up a new QuickBooks file, just helps tremendously, right? It like, you can almost figure anything out, right? Like after the fact, if it's running off of separate bank accounts and separate credit cards, right? It's very hard after the fact to go back and try and peel different business lines apart. So
yeah, I think people experience that on real estate teams too, on the smaller teams or individual agents where they have commingled personal expenses with business, and it's a nightmare, not fun. Yeah. Okay.
no.
You have, Brooke, can you drop the, Michael has a download 7 simple steps to healthy real estate finances on his website. So Brooke's going to share the link. If you guys want to watch this back because you want to write down some of the stuff that Michael said, Brooke will drop in the link. We'll put it up on YouTube later. And the only other question we didn't get to, and we're way over time because we were supposed to finish at 2:30. If you have a couple minutes, we'll
Sorry.
be on.
No, I'm
Okay.
I'm free.
So the last question that came in was, what things should people be looking at in terms of financial goal setting as they're setting goals for 2024? We see a lot of people setting goals around GCI and they forget that they should be setting goals around profitability. And
Yes.
is my owner in production or not in production? And I'm looking at the MREA models and all of that stuff. What do you want to share about that?
Yeah. So I think you have to start with your net. I think that's where every conversation needs to start. I think this is where conversations need to start with between rainmakers and agents that they're trying to attract to their team, right? I think this is where brokerages and agents, right? This is where they should be starting their conversation. And for agents, right? Team leaders, rainmakers, they need to look at, okay, what is my goal for net income, right? That's the real number that affects my life. And then I want to reverse engineer what that looks like in terms of units, right? And then from units, what does that look like in terms of signed, right? Signed agreements. What does that look like in terms of appointments? All those types of things. I think so many of us just start with like a number that we think looks good, right? We're like, I'm guilty of this myself in my own business, right? Kind of every business owner just sort of looks like, oh, if I get that number, things would be great. If we did 100 units, it would be great. If we did 300 units, it'd be great. Like, okay, well, why? Right? Like, where does that leave you, right? As the owner and the beneficiary of the team. So you start with net income, and like, there are some really good, if you can take an MREA business planning clinic, right? Or just find the business planning clinic workbook online. It's very simple, but it's a wonderful exercise. It will walk you through, like, it's just a table. It'll walk you through every calculation you need to do from sort of your net income goal to how many meetings do I need to have this week. I actually took that concept and I just made a simple like spreadsheet calculator that you can also download on my website. Just to sort of help like spark these things. And you can look at the formulas and see, oh, okay, that's how he's like, that's how they're getting to these numbers. Oh, okay, this is how they're dividing by a decimal, right? Oh, that's how they get to this other number. So yeah, so I would go find that, right? Go find that page in the MREA business planning clinic and do the exercise. And the unit goal, right, or the unit amount might really surprise you. So
yeah, because I think most teams do it backwards. They start with either a GCI or a unit goal and end up not being profitable or not making the amount of money they want to make. So yeah, it's about starting at the bottom line. So love that. And then last question was around profitability goals and profit margin goals as compared to MREA, Rainmaker in production, Rainmaker out of production. I can tell you what Gary Keller says. I would love to know what you see, because I'm betting you see different things than what the model is. And so typically we hear 40% profit margin is the goal with Rainmaker in production, 25 to 30% is the goal with Rainmaker out of production. What are you seeing with your medium and large teams?
I'm actually, it's actually where I'm seeing people.
Okay.
Is in those. They didn't just come out of like nowhere with those. Most of my clients are running in that range. Now, they are not running at the same pace they were running in 2022 or the second half of 2021. I can tell you that. I think everybody's experiencing that, right? So
Yep.
the year-over-year comparisons, yeah, I mean, they're dire. But
when and those of you who are with agents, I know we have some on here who are with solo agents, they're going to see much higher profit margins.
Oh, yes.
Which is awesome. And be aware that if you're growing a team, that profit margin is not going to stay super, super high as the team grows and you have infrastructure that you have to put in place.
Yeah. Yeah. And you also will see these dips, right? So you'll have these profitability troughs, right? Where you'll see like, Like you're never going to have a higher margin, right, in terms of percentages than when you are a solo agent who is in a capped model and just crushing it, right? Like you're going to run at super high 70, 80% profit margins. That's what it is. But as you build the team, right, your gross profit margin is going to get compressed, right? And then your profit margin is going to get compressed, right? And you will end up, maybe you'll end up with a rainmaker in production, a couple of good buyers agents, you'll end up in that 40% profit margin range.
And the
Then
goal
if
is
you
that you're
build-
making more profit.
Yes,
Dollars.
yeah. So that, yeah,
Your
the
margin
absolute
might
number.
be smaller, but your dollars, the goal is to grow the dollars, right?
Yeah, if both your margin and your dollars went down, what are you doing, right? Like, okay, we're
Right.
not doing this. But then as you build, right, it's sort of the next level of building where you're phasing yourself out of production. You're putting more people into the business. You're building your operational staff, right? You're just taking on more risk, right? And you have to invest the dollars sometimes before you know that they're going to come back. So you'll see some dips in margins, but it then should stabilize at around 20 to 25% margin if you're totally out of production. And that's what I see with my teams.
Yeah. So that's another goal that when I'm talking to my coaching clients too, when you're setting your goals for next year, we should be setting profitability, profit margin, and profit dollar goals, not just production goals, right? Yeah.
Right.
Okay.
Yeah.
Awesome.
Yeah.
All right. Well, we put Michael's email is in the chat. If you guys have questions, reach out to him, reach out for the download. He is super, super wise. I wish we had more time. Thank you guys for joining us. And Michael, thank you. Any last words you want to give?
No, thank you. Thank you for having me on. And thank you guys for spending time with me.
Awesome. Okay, you guys go out, make lots of money, 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 and we'll see you back next month. We're doing a book blink on the gap and the gain, and we'll see you then. Bye, guys.